in this session on our conversation on professional responsibility and liability. Okay, so let's look at the fourth unit, speaking to managing the auditor's liability. So this fourth unit will be examining 4 sessions, how auditors can avoid liability. So avoiding liability, and where the liability comes, we should be able to meet claims, professional indemnity and insurance. And also we should be able to limit liabilities by mitigants and stuffs that could be put in place to help auditors navigate situations and circumstances that speak to challenges around liability management. All right, speaking to that, the first section is avoiding liability. Clearly, it is preferable to avoid liability arising from negligent auditing. So, issues of negligent auditing could be avoided, clearly, because firm can minimize these risks of being sued by ensuring that their staff perform high quality audit work. Very important. So when an audit firm is concerned about performing high quality work, providing value to clients, then liabilities could be avoided. Is key. So it's the other way around. When auditors don't provide high quality work, then liabilities are inevitable. And in doing this, auditors should therefore, number 1, follow appropriate auditing standards. The ISAs are there for a guide. So understanding them and applying them practically would help avoid liability. Using effective quality control procedures in performing audit testing, analytical procedures, and doing the field work or the audit work is very important. So quality control procedures are essential. Staff training to an appropriate level of knowledge and skill is also essential for every cadre that are involved in the audit firm. Staff training is key. It enhances quality audits. Also ensuring that the firm is up to date with modern auditing methods is key. So currently ISQZs are scrapped. So audit firms should know that ISQMs are the current standards for quality management, international standards on quality management. So current and modern auditing methods as provided by ICAN, because ICAN are very proactive in adapting to these international standards. So firms should also be up to date with this auditing method is key. And those are principally the ways to avoid liability. Like I said, liabilities are avoidable if the appropriate mitigants are put in place. Very key. So in meeting claims of professional indemnity through various means, including insurance, is the next section. So if successful legal claims are made by clients, or if out of court settlements are reached, where the audit firm agrees to make a payment to settle a dispute, the auditor will have to pay damages, of course. If the damages are so large that they cannot, or they are more than the firm's capacity, the law in some countries may also allow claims to be made against the personal assets of the partners of that audit firm. So meeting these claims have to be navigated intelligently, because it could be up to the personal assets of the partners, the owners of the firm. So the threat could be very high in terms of even closing down that firm, because their financial capacity may not be able to meet those claims. So major audit firms as well could be affected, and also small firms, speaking from the big 4 down to small and co 1 or 2 partnership kind of firms. So liabilities could threaten the existence or going concern of some of these firms. And professional accounting bodies take the view that the image of the profession will seriously be damaged if claims awarded against auditors and accountants are not met because of lack of financial resources. The public's view of chartered accountants and also the way we are seen could be damaged. because it's a noble profession and trust is very important. So professional accounting firms try to ensure that whatever claims are presented to auditors should be within the purview of their financial might. And also, these professional bodies often require members in practice to carry professional indemnity insurance. So appropriate premiums are paid, or designated premiums are paid yearly in case claims like this come in future. Auditors will be able to cushion the effect of this financial burden by insurance. And that's what professional indemnity speaks to. So professional indemnity insurance is a policy that provides cover against any civil liability. Take note, civil liability and not criminal liability. Criminal liability are not covered by professional indemnity. Criminal acts are not covered because they are unlimited in claims. But civil liabilities could be covered by insurance. And these civil liabilities that are incurred as a result of the conduct of the firm's work with clients could be covered. So money is paid out from the insurance firm on these policies if the firm finds itself in this situation and is unable to pay. So that's how to meet claims. So take note of the fact that professional indemnity insurance covers only civil liability. It does not cover criminal liabilities of auditors. Take note of that. All right. And finally, the next section is limiting liability. How should auditors limit liability? Statutory limits on claims, speaking to the percentage of fees or amounts, are areas where limiting liability could ensue. Agreements with clients to cap liability is allowed in some areas, some countries, some jurisdictions. Also, limited liability partners for audit firms could also limit liabilities in terms of the kind of job they could do or to engage in. Professional indemnity insurance for directors of client companies, also disclaimers in audit reports could help limit liabilities for audit firms. So there are statutory limits speaking to percentages of fees or fixed amounts that could be meted against a particular number of firms. For example, the Big Four could have a particular amount that is meted out to them at the court, or these SMEs, the small audit firms could have a maximum amount or percentage that could be fixed so that you don't crash such firms. An agreement with also clients to cap liability is allowed in some areas or some countries. That, okay, if anything goes wrong, this is the limit to which I'm liable. Also, for limited liability, they could also have limits where there are a lot of number of firms. Then also professional indemnity insurance for directors and client companies could help reduce these liabilities and limit it. Then disclaimer in audit reports could also help audits, and that is why it should be used appropriately. Disclaimer of reports should be used, especially where scopes, where informations are not provided to auditors. Disclaimers should be used. It's one of the 4 audit reports speaking to qualification, unqualified reports, adverse opinion, and disclaimer of opinion. That could be used to reduce the liability, limit the liability for audit firms. So that's generally how to manage the liability for professional accountants or auditors in the business space. So having spoken to that, in reviewing this chapter, we'll be looking at chapter 5 in the next lectures. We should be able to address or speak to what expectation gap is, having finished this conversation, and how it arises, and the applications of ISA 240, fraud and error, and also describe how an auditor's liability may arise both criminally or civilly, and explain how it can be managed. The summaries of this chapter, chapter 4 we just looked at, is for us to remember the importance of professional skepticism in doing our work, whether external auditors, internal auditors, accountants, finance managers, whatever space you're working in, you must ensure that your professional skepticism is intact. Don't take everything at face value. Understand the legal framework surrounding auditors' liability, and this cannot be overemphasized. All right, that's a safe landing on chapter 4. Do we have any questions, contributions, observations? So we could quickly run and see how much question and answer we could cover.